Hi everybody, good afternoon. Hi. Thank you. Now I'm just so thankful that so many of you still stayed behind after that refreshment. And as I was coming in, I talked to quite a few people who have attended my talk before. And I actually felt very happy, even as I speak to them, that they've been telling me, they've been doing things correctly, they've been saving money. Now I've been following your tips on savings. I got a lot of money already, what to do next? So I'm quite happy about it. And I really enjoy talking to, or rather speaking events like this, because it gives me a chance to really talk to people on the street, men on the street, and share the little I know on financial planning. And really at the end of the whole seminar, sometimes I feel really very good. You go down, then you have a lot of people coming to you, and then they ask you questions, you feel like a movie star, You feel really good and say, I'm so clever. But I'll tell you this, in the very first Mind Your Money event that we did at the beginning of this year, the celebrity was Teh Ping Hui and Xiang Yun and Edmund Chen. So I had this panel discussion with Teh Ping Hui, and then everything was over. And then I see all these people coming, I said, again, I feel really good. Then they came right to me and they said, can you help me take a picture with Teh Ping Hui? God brought me down from the top all the way down. That sometimes I'm not that good. It's not me. It's the knowledge that you hunger for. The topic that's given to me is on making effective investment decision. For those of you who have attended this before, last weekend, CPF, Mind Your Money, you can go home. It's the same thing. I don't have any other things to say. It's just the same investment topic. So I was quite worried, and Nicole from MS said, can you tweak your talk now? I said, what, tweak your talk now? Tweak my talk now? I can't do it. But I think that these concepts I'm going to share with all of us, although I've shared it many, many times, it is good to refresh them. And although they are very simple, sometimes it's the simple things that are very hard to do, isn't it? Yeah? A lot of things are common sense, but it is very, very hard to do. So I hope for those of you who have even though you've heard it before, I hope, you take this as a refresher. And I find for myself, when I listen to a seminar and I say the same, or rather when I listen to the same thing over and over and over again, I get better. And by the time you get really bored with what I have said, it is time for you to move on, and then you go and attend other seminars, which is really important. Yeah, because what we teach here is really basic, but if you want to find out more, you should really attend other workshops, after this. Okay, so I'm going to start making effective investment decisions. I want to start by sharing with all of us this whole concept of whether we should invest. Because I believe that if you don't have to invest, and this is my own personal opinion, then you don't need to take that kind of risk. If today you have got $1 million in your bank account, and even after you adjust it for inflation, if it's enough to take care of you for the rest of your life, actually there is no need to invest. Why go through that roller coaster ride and take that risk? So let's see whether there is a need to invest. And the best way to show it to you is by use of a timeline. Now, assuming this is your timeline, and you are now down here, regardless of your age. For most Singaporeans at the age of 55 or 60 years old, they want to slow down, retire, or what we prefer today to call financial independence. And financial independence really means different things to different people. And Mr. Para has actually already explained that. I won't want to spend too much time on this. But financial independence simply means that it is a time of your life whereby you work because you love to work and not because you have to work. That is financial independence. And what that means is for most of us, in our lifetime, we will have about 20 years of our life. I know some of us are retirees here, but for most people, we have about 20 years of our life whereby in these 20 years, we work very hard, we earn the most, but we also spend the most money. Isn't it true? Yeah, because we work very hard, our career moved up, we get promoted, we earn a higher salary, but we get married, we have children, and we know children can be really expensive. I know, I have two, 8 and 12. Especially when it comes to primary 6, very expensive. Because primary 6 is the year when the parents all gabra. PSLE is going to happen in 2 to 3 months' time. Go to popular bookstore, you know. Plenty of people queue up to buy assessment book. Tuition fee can be very expensive. So although you earn a lot of money, this is also the period that you spend the most money. But this is also the only time you have in your life to prepare for your remaining 20 to 30 sunset years of your life, whereby you no longer earn, or you may earn a lot lesser, but you still have to spend, at least until about maybe 75, 80 years old, because the life expectancy, the average life expectancy of Singaporean male is about 70. What is the average life expectancy of Singaporean male? Guys, how long do we live until? 70? You get an iPhone for getting it correct. I bluff. Okay, 78 I heard. See, iPhone works. Now, so 78 is the average life expectancy of the Singaporean male. How about ladies? How long do we live until in Singapore? 80? 83. You must have attended my talk before. 83. Generally speaking, ladies in Singapore, you live 5 years longer than the guys. But globally, the ladies, you live about 5 years longer than the guys worldwide. Why? This morning I was practicing my talk, so I asked my wife. Actually, she knows the answer. She said, I don't want to tell you. Okay, reason number one is because, especially if you're married, the wife nagged at the husband so much that the husband rather die 5 years earlier. Of course, I'll be stoned if that's correct. Now, the real reason is because, well, the ladies, you live longer than the guys because, well, you take care of your health better, generally speaking. Number two, you take stress and pain better. As much as we guys have to think that we take pain and stress better, it is the ladies that take pain and stress better because they have the hormones for it. The guys, we just don't have it. That is why, ladies, you are made for childbearing. If the guys go to the labor ward, 1 cm dilation, die already. We can't take the pain. So that's why, for all these reasons, the ladies, you live longer than the guys. But whatever it is, our government is saying that on average, we are going to live until about 85 years old. It's a long time we're going to live. So let's assume today, when we retire, let's assume that you want $3,000 per month per couple when you retire. Now, let me ask all of us, is $3,000 per month per couple a lot of money to retire on? Is it very luxurious retirement? Answer is no, of course not. 3,000. But let's just say that this is what we want, and this is just what we can afford. Let's just say that. So $3,000 a month, $36,000 a year per couple. That's what we want. And if you are now not retiring, I can see a lot of young people, so you're not retiring today. Okay? Let's say you're going to retire in 20 years' time. We all know there's inflation, right? Inflation means what? Things becoming more expensive, or the same $1 can buy more or less things. Lesser, that's inflation. We all understand that. Great. Now, so let's assume inflation to be 2.5%. In 20 years' time, in order to buy you the same $36,000 lifestyle per year, you will need about $59,000 to $60,000 in 20 years' time. Am I being clear? Yes. Yes? You all know you are the quietest crowd amongst Mind Your Money. Can you all answer? Even you whisper, I can hear you. In 20 years' time, to buy the same lifestyle of $36,000 or $3,000 per month per couple today, I will need $59,000 a year. Am I correct? Yes. Good. Thank you. So you need about $59,000. And then, let's do some simple mathematics. Now, regardless how long you're going to live. Okay, let's assume we all live another 20 years at the time we retire. If you need $59,000 a year, I just do simple mathematics. I multiply it by 20 years. You will need about how much? 1.18 million, about $1.2 million. Now, is $1.2 million a lot of money to save towards? Oh, no. You're in the wrong seminar, I'm going home. There's one more somewhere else conducted by the private bank. Is $1.2 million a lot of money? Yes, unless you are those type. I know of some people, those type, last month's salary haven't finished, this month come already. Then they get very angry. Wow, last month's salary haven't finished, this month give me. Very angry. If you are the sort, then 1.2 is nothing. But we will generally agree that 1.2 million is quite a big amount, right? Now that's lesson number one. It is because we need such a huge amount that we really need to save and invest towards it. But the misery doesn't end here. Why? Because we have children. If you have kids and you want to send them to university in about 15 years' time, one child for a 4 years degree course in 15 years' time, local, SMU, NTU, NUS will cost about 150,000. If you have two, most of us here we have two, then you will need $300,000. You add it all up. By the time you retire, you will need about $1.48 million. For what? To live a palace-like lifestyle and send our kids to Browns, Harvard, and Cambridge, like what Diana said just now. If you can make it to Harvard, don't worry, sure got scholarship one. But it is only to local uni, and yet we need such a huge amount of money. And unless we already got the $1.5 million, I think we all agree that we really need to save and invest. Save is not enough. We need to invest it towards this very big amount, right? Am I right? That is why you need to invest. Otherwise, if you already got this money, actually you don't have to invest. What for? What for go through that roller coaster ride? But it is because the amount is so huge, we need to invest. And you better pray. You better pray that your kids don't come back home and say, you know, my A-level result not too good. I cannot make it to local U. I want to go Australia. Then you die. Or they come back and say, actually, I love to watch English Premier League. I want to go to UK. Then you die. Or they come back and they say, oh, High School Musical look quite fun. I want to go America. Then you die. Or they come back and they say, I want to be a doctor. Then lagi die. Because we know why? It's a lot more expensive. And I've just given you the slide to show you that inflation, or rather inflation rate for tuition cost is about 6%. So it can be really expensive. That is why there is a great need to save and invest towards it. And if you really want to save and invest towards it, where do we start? And I always like to show people this chart. This is really the chart of the stock market return over the last 100 years. And I always show this. Why? Because General George Patton, the general that led the US Allied Force during World War II, says this, that we study history not to know the dates, but we study history to know what to do right and what to do wrong. And therefore, history is a very good teacher. If you look at the stock market returns over the last 100 years, okay, the stock market return is the one on the top. The bottom three, they are not stock market, they are just bonds. Okay, so look at the top line. This is the global equity represented by US assets. Although it's only US assets, this study, actually done by Credit Suisse, studied 17 markets in the world that constitute 90% of the stock market. So it's pretty accurate. I'm just showing you one. Okay? If you look at this particular chart, we can learn some things. The first thing we can learn is that over the last 100 years, there were three big crises. The first one happened between 1930 to 1940. We all know that to be the Great Depression. Between that 10 years, the stock market came down 89% in just 2 years. That was the Great Depression, the biggest crisis in human history. The second big crisis happened 40 years later. If you add 40 years to 1930, it's 1970. And that is the oil crisis, otherwise known as the Middle East crisis. You can see the stock market coming down as well. Okay, generally flat. Now, interestingly, if you add another 40 years to 1970, there will be 2010, this year. But of course, we all know that it happened earlier. It happened last quarter of 2008 all the way until 2009. Now, although we don't feel it here in Singapore because we are pretty well shielded, it is really the second biggest crisis in the last 100 years. The first being the Great Depression, second was the last one, and the third crisis, the oil crisis, and the Middle East crisis. That's the third one. So there are three crises over the last 100 years, and I hope that is actually an encouragement for all of us. Why? Because a big crisis don't happen every other year or every other day. Life is going to be very miserable if it happens so often. A very big crisis, like what we have just gone through, only happen every few decades because it takes many years of all the wrongdoings, all the greed to be able to create such a big crisis. Okay, that's the first thing we learn. The second thing that we learn, and I hope also is an encouragement to all of us, is that no matter how bad the crises are, they always recover, isn't it? In the Great Depression, it recovered. In the Middle East crisis, it recovered. And of course, we are still in the midst of recovery. And during recovery, there's a lot of ups and downs. But all crisis recovers. And that's good news. The third thing we can observe from the last 100 years is that the stock market generally always goes up. It always goes up. Can you see that over the last 100 years? Why does it always go up? The stock market always goes up because all of us as human beings, we have our basic needs. And as long as we have our basic needs, corporations will continue to exist. And because corporation exists, productivity will help the business do better. And also inflation will cause the stock market to go up. So the stock market always goes up. But Let me just say this. Firstly, if you buy one stock, it doesn't apply. Because if you buy one stock, if the company collapses, that's the end. Yeah, but I'm talking about the entire market always go up. Secondly, the caveat is this. In order for whatever I say to work, you must have time. You must have time. Because if you are investing and you need your money tomorrow, this doesn't work. Because if you are investing at the tip of the depression and you say, Christopher say, stay invested, but next year you need the money, you die. Because the market never recovered until many, many years later. In fact, until 10 years later before it came back up. Can you see? From the tip of the Great Depression, it took almost 10 years before it came back up again. So for me, or rather for this to be true, you must have time. And I hope it tells us one thing. And that is, investment is always long-term. If you want to get short-term return, then you must find the best time to get in and out of the market. And we all know that is speculation. So how do you define investment? Speculation, a lot is by time. Investment is always, you have at least, I've said, you must have at least 5 to 10 years. Okay? To be safe, I'll say 10 years. Those of you who attended the CPF talk last week, you will know I said that even though you are a retiree, please don't think that you don't have time. You have time because you're going to live until another 75, 80 years old, right? What did I just do? Okay, I just switched it off. Doesn't matter. Now, so in order for this to happen, like I say, you must have time. Okay, so that's one thing we learned. But there's also one thing I want to share with all of us from the stock market over the last 100 years. Some of you have heard this before, but I don't know whether it has gotten in. Okay, and that is this. If all you want is just to get the average return from the stock market, that's all you need. By the way, the US asset returns or the US stock market return gave about 6% on average over the last 100 years, on average. If all you want is just 6%, that's all you want, and you calculate and you worked it out, and that's enough for you to reach your goal, whatever your goals can be. It can be 500,000, 1 million, doesn't matter. Whatever your goals are, if let's just say 6% is what you need, do you realize that all you really need to do is just to stay invested in the stock market? There is no need to get in and out, because the stock market will go up and down, up and down, up and down, but it will always give you an average of 6%. Do you see? Can you see that? There is no need to try to find the best time to get in and out. The only time and the only reason why you want to get in and out of the market is when you want to beat the market. You want to get better than 6. You want to get better than your friends. Because your friend gets 6, you must get 7. Your friend gets 7, I must get 7.1, also I come 1. Otherwise, not happy. Now, if you always want to maximize your return, you always want to beat someone else, then it's very important to get in and out of the market at the right time. When the market goes up to the highest, you must sell. When it comes down at the bottom, you must buy. When it goes back all the way to the top, at the peak, you must sell again. When it comes down, you must buy. And you must do it with snapshot accuracy all the time. Do you think you can do that accurately all the time? To beat the market is a zero-sum game. Which means to say that in a stock market, if there are 2 players, you and me, in order to beat the market, if I win, you must lose. Once you start trading the market, 50% you are a loser. You have a 50% chance of losing. What makes us so sure that we can beat all the big boys out there? You understand? There are many, many big boys that you are contending with. Your George Soros, your Warren Buffett. These are the big guys. What makes us so sure that we can beat them? We can beat them once. What makes me so sure that I can beat them all the time, consistently? It's hard. It's not easy. But that's what trading the market is all about. It's about beating someone else. But do you need to? Must we always win someone? If you don't have to, if all you need is 6%, for example, whatever that percentage is, then all you need to do is really to stay invested. That's all you need to do. Am I clear? And therefore, the very first step is investing, or rather the very first step in investing is to determine how much you need. Not just the amount, but the percentage that you need. If you go to the CPF retirement calculator, you can actually work out that number. That is very important. It is very important to know the percent that you need, because without that as your guiding post, you are going everywhere. Okay, you just need that percent, that number, and you invest based on that number, and be very, very one-minded about it. I want to get a number. That guiding post will help you to make all the investment decisions. If all you need is 5%, you may want to reconsider whether you want to buy the next property, because you don't need to buy a property to get 5%. You understand that? That decision is important. So I hope you think about it. Some of you who have sat through my seminar, I hope you still find this useful. Think about it. Okay? Let it get into you. And you really have to be the person to determine how much you need. And I say need and not want. That's important. Now, but I always say, you can hear me many times. And I preach this many, many times. You can get it here. But it doesn't flow down here. We all know that we must, guys, before I go for the next IPPT run, I must wake up in the morning, every morning to jog and practice. But at 6 o'clock, when the alarm clock rings, throw away because my heart don't want. Never mind, still got the next day, right? Until we go for the IPPT, then we slog like mad, we finish, we pass, but we vomit like mad at the end of the end point. Then we say, no, next year, I must go and train because my head says, I must train, otherwise I'll suffer, right? Tomorrow wake up, one more year to go. Because here we know, but it doesn't translate down here. It's always like that. Knowledge doesn't mean action. I think, I feel, I act to get result. You think but you must feel it, then you will act it out. If you think but you don't feel it, you will not act. So, I will know that although you know this, but when you start investing and as the market takes you up and down, up and down, up and down, we can't take it anymore. We will feel like vomiting. How then to keep yourself invested? And one of the things that you can do is to invest in an instrument or invest in a portfolio that is suitable for your risk profile. And that's where we start. How much time do I have? I need to check because I have no sense of time. Someone tell me, okay? Because I only got 45 minutes. So in order to make sure that we keep you invested regardless of the ups and downs, okay? One of the first things you can do is to invest based on your risk profile. You don't invest on a product based on risk profile so that you pass the MAS compliance. That's not the reason. The reason that you invest based on your risk profile is so that regardless of the ups and downs, you sit tight. So in order to understand your risk profile, 3 things you must know. Firstly, it is your need to take risk. Secondly, your ability. And the third one is your willingness to take risk. Now, how do I determine your need to take risk? Your need to take risk, as I mentioned earlier, depends on your need for returns. Today, if you are 35 years old and you are planning to retire at the age of 65 years old, you've got a good 30 years, and you worked it out and you say, I need $1 million to retire. Let's just say that. And you've got 30 years and you're prepared to put in $1,000 every month to invest. Then you know that in order to reach that 1 million in 30 years' time, you don't need that high a return, right? Yes or no? You got $1,000 to invest, $12,000 a year. You got 30 years to reach $1 million. You won't need that high a return to reach your 1 million. But however, if you need 1 million at the age of 65, but you are 62 today, and you haven't started, but after listening to this talk by Moneysense, you resolve in your heart that you are going to invest tomorrow. And you say, I will invest $100 tomorrow every month. To get $100 every month, $1,200 every year, and in 3 years' time reach $1 million. You think that's possible? Is that possible? Not possible unless you use the high-risk instrument called 4D. And you may not get anything like what Mr. Parag alluded to just now. But even if it is possible, we all know that in order to reach there, you got to get a very high return, yeah? And if you need to take, or rather you need that high return, you need to take what? High risk. Is 4D Toto high risk or low risk? Someone told me 4D Toto is low risk, high return. Pay a bit can win a lot. I'll prove to you very quickly that it is not true. Because if every week you go to Singapore Pools Bank and you invest with Singapore Pools Bank, and you put in, say, $50 with Singapore Pools Bank, at the end of 1 month you would have invested how much? $200 with Singapore Pools Bank. At the end of 1 year you've invested $2,004 with Singapore Pools Bank. At the end of 4 years you would have invested close to $10,000 with Singapore Pools Bank. And you walk to Singapore Pools Bank and you say this, how much is my investment value at now? Singapore Pools Bank will look at you and say, you siao ah, it's zero. But because this is Singapore Pools Bank, we don't make noise, we accept it. Because if this is any other bank, today we will be at Hong Lim Park. What kind of stupid bank invest my money 4 years, get nothing one? Right or not? But because it's Singapore Bank, nothing. That's why every year, MediaCorp can host this kind of show, and Singapore Bank can give a check, right? And donate. If you have truly invested in 4D, don't need to donate money anymore. You would have donated. True? So, I'm like dinosaur, what was I talking about? Okay, need for return. Your need for return. Getting old. I'm actually 40, although I look like 20. When you're old, you always want to look young. Anyway, your need for taking risks depends on your need for returns. Okay, so if you need high return, you need to take high risk. You need low return, you need only to take low risk. So that's the first thing to help you determine your need to take risk. That's why I say it's very important to know how much you need. Now second, ability. What determines your ability to take risk? Now generally speaking, the younger you are, the higher ability to take risk. The older you are, the lower ability to take risk. The longer your time horizon, the higher ability to take risk. The shorter your time horizon, the lower ability to take risk. If your financial health is very good, you have done your budgeting, you have 6 months of monthly expenses in cash, in bank, you don't invest it, you have money in the bank, higher ability to take risk. If you have no money in the bank, very low ability to take risk. If your income is very stable, high ability to take risk. If no stability income, very low ability to take risk. If you got high debt level, and as a guide, if you are using more than 35% of your income to pay debt, you are unhealthy, then very low ability to take risk. If you got very low debt, very high ability to take risk. If you are single, higher ability to take risk. If you are married, lower slightly ability to take risk. If you are married with 2 kids, largely lower ability to take risk. If you are married with 10 kids, I always say this, you have zero ability to take risk. If you are physically very healthy, then higher ability to take risk. If your insurance all done up properly, then what? Higher ability to take risk. If you don't have any life insurance, then low ability. That's why you must build your ability to take risk before you take that next step into investing. Willingness. What determines your willingness to take risk? Now we all know in Singapore, before you buy any financial products, you must fill up some risk questionnaire. Yeah? Yes or no? Yes. If anybody sell you product, no. Down here MAS people complain. Because we are supposed to fill up risk questions before we can recommend a product. But please know this, the risk questionnaire that you fill up, that 5 to 7 questions you fill up, that add up all together, and then we say that you are low, medium, high risk, only measures one thing. It only measures your psychological willingness to take risks. It doesn't measure your need, it doesn't measure your ability, it just measures whether you want or not. Are you willing to take that risk or not? To really understand the risk profile, to really understand who you are, you got to align the 3, need, ability, willingness. Let me illustrate. Some years back, and I always use this example because it's a true story, and true stories are powerful. Some years back, I've got a client that came to see me. He was 60 years old back then, and when he came, he had $500,000 from his retirement. Not a lot for what he has done in the past, because he lost a lot of money during the tech bubble. Now, although he had only half a million, he's a very frugal and prudent guy. He said he only needs $1,500 every month. And based on 60 years old, based on half a million, and based on the $1,500 that he needs, we worked it out that he needs only about 5% return. Now, perhaps it's a good time for me to show you that generally speaking in Singapore, when we say risk-free rate, we always use CPF, and that is 2.5%. When we say low return, we generally refer to about 5%. Medium return, we generally refer to about 7%. And for high, about 9%. That's generally the case. So this gentleman only needs 5%. Therefore, his need for return is low or high? Low. Thank you. Therefore, his need to take risk is low or high? Low. His need to take risk is low. Ability. All of you tell me, assuming today you're all financial advisors, so you tell me. He is 60 years old. He is retired. No more income. Once he starts investing, he needs his money tomorrow. He cannot afford to lose his money. His health is not too good. Cannot buy any more insurance. One more son, preparing for A-levels. Back at the time. His ability is low or high? Low or high? Low. Willingness. This guy, incidentally, this guy was my ex-boss. He used to be working for the commandos. Not all commandos love to take risks, but I know him very, very well. Even before doing the risk profile question, he told me, I'm not interested in low return. I want high return product. I don't mind all the risks. Make me sign all the form. Compliance, no problem. But you must give me high return product. So his willingness to take risk is need not, cannot, but want. What do you call them? T key. Correct, no? Need not, cannot, but die want. So how? Should we give it to him or not? No. Answer is no. If you need not, you cannot. Even if you want to, you should not. Can you see why it is important for you not just to do that risk profile, and because it doesn't determine your risk profile 100%, you really must start with understanding your need and your ability to take risk. Am I being clear here? Yeah? Now, I'm going to give you the second example because the second example is important. About the same time, a couple came and see me. Both of them were about 30 years old back then. They are very, very successful in their career. They have done very well in school. They went to MIT for their education, and both of them are aerospace scholars. Very good. Now, when they came to me, they have got big goals. They want to retire at the age of 45 years or 15 years from then. Big dreams. They want big house, big bungalow, 2 cars. Must be Continental car. Cannot be Japanese car. So we worked out their goals, and it happens to be about 9%. About 9%. Now, based on this, their need for return is good. Therefore, their need to take risk is good. Ability, 30 years old only. Very good income, 27,000 combined every month. No children yet. Debt level, very, very low. Insurance all done. Physically very healthy. Ability to take risk is good. Willingness, unwilling. The one. Because they say scared, the risk. So this is different situation. A couple need, can, but don't want. Then how? Well, I always use this equation, which actually I have it on the slide, but I'm going to draw it here. This is a very, very difficult equation. It is called the time value of money equation. Future value equals to present value 1 plus r to the power of n. You all seen this before? Oh, you're all so smart. Huh? Okay, this is a rocket-sized equation. Now, this couple got huge goal, so therefore future value is very high. But because R don't want, because don't want to take risk, right? So R very low. So how? So I went to them and say, can you, in order for me to give you what you want, can you like put in more money or not? So if you put in more money, I can still give you what you want. Yeah? Cannot. Chris, all the surplus give you no more money. So this one cannot, very low. Then can you don't retire at 45 years old? Can you retire at 60 years old? Cannot. 60 years old cannot see. Must retire at 45 years old. So this one also very low. Then I tell you what, can you don't have bungalow, can condo please? Can don't have 2 car, 1 car, and then don't have Continental car, Japanese car can? Cannot. Must have Mercedes Benz. So this one very high. So I don't know. I learned in school before, although I never went to MIT. Although I'm only a Cambridge graduate. I'm Cambridge. You're all Cambridge, right? GC, O level, A level, all Cambridge. Cambridge, right? I know that low multiplied by low multiply of to the power of low cannot give me high, right? Then how? Something must change. So I'm going to go to the washroom for a while. When I come back, please tell me there are only 4 variables here. I've got to change one. So after many minutes and seconds of high-powered MIT discussion, they decided that they really want their future value. They cannot put in more money already. They really want to retire at 45 years old, so no choice. Got to take more risk. You got me? Now, this equation is easy, but it's hard to understand. Why? I want to tell you this, okay? I didn't prepare this for this speech, but I want to tell you this, and that is, it is very, very unrealistic to expect more than 9% every year. You understand? In the 1990s, when the stock market had a bull run, you get an average return of 13%. Those were the years you remember. Don't need to see what IPO you are reading. No time to read IPO one. Come out, go ATM, press, maximum. Because you may get, out of 10, you get 3. Remember those years? Those are the bull run years. They are over, passé already, no more. Going forward, returns is going to be a lot more muted. It is impossible to expect double-digit return. Or even, for that matter, you cannot expect 9% above every year or 10% above every year consistently. It's very, very, very hard. If you decide that you have a very big goal and you need to get like 10%, I suggest that you rework your lifestyle and lower this so that you don't have to take so much risk to get your goal. You understand? Okay? It is not realistic at all, okay, to expect very high return. It is better that you lower your lifestyle or earn more money. Okay, invest in yourself. Most people think that investment helps me become rich. It is not investment that helps you become rich. The key to becoming rich is actually your income. Whether is it your work or business, it is your income. Invest in yourself, earn more. Okay? Investment is for you to preserve your money, let it beat inflation, and give you a lifestyle that you need. Please remember this. So once you decide your risk profile, I'm left with 10 minutes. Okay, because later on, Brian Wong is going to come, and I know that you want to see more than me. I know. So I will finish at 10 minutes time, okay? Now, so once you have determined your risk profile, the next step, of course, you can invest. But I just want to quickly say this, okay? Because low risk, high risk, medium risk means different things to different people. We always say you're medium risk, but what does it mean? Because medium to you can be high to me, what? Low to me can be nothing to you. You know what I mean? So just to give you a guide. Now, if you are low risk and you want 5%, please be prepared for your investment to go up plus minus 3%. If you want 7% return, please prepare for your investment to please be prepared for your investment to go up plus minus about 8% as a guide. If you are expecting about 9% return from your investment, please be prepared for your investment to fluctuate between plus minus 20%. What this means is that in a very good year, your investment for low return will go up as high as 5 plus 3, 8, 5 minus 3, 2, and then 2, 8, 2, 8 on average about 5. For this one, 7 plus 8, it can go up as high as 15, can go down 7 minus 8 minus 1, minus 1, 15, minus 1, 15, average 7. This one, 9 plus minus 20, 9 plus 20, it can be as high as 29, or 9 minus 20 minus 11, minus 11, 29, minus 11, 29. That is the fluctuation. And this kind of characteristic up and down happens 2 out of every 3 years, or 4 out of every 6 years, or 6 out of every 9 years, 2/3, 67% of the time. Because in 1 out of every 3 years, 2 out of every 6 years, or 3 out of every 9 years, it can go haywire. It doesn't follow this anymore. But most of the time, thankfully, it follows this kind of fluctuation. Are we clear? So if you want 9%, you must be able to accept the roller coaster ride of plus minus 20. Close your eyes and imagine that. Can you take it or not? And in a ridiculous year like last year, it can be 2 times plus minus 40. Can you take it or not? This number in investment, we call it standard deviation. It is a measurement of risk, just like cm measure length and kilogram measures weight. Next time, before you buy a product, ask, what is the standard deviation? You sound very smart. Although we only know one word, never mind, sometimes one word enough already. Understand? Now, let's just say today, I calculate, all I need is 5%. That's all I need. Okay? Therefore, the portfolio that I must invest in is a low risk portfolio. Goodness me, I only finished 1 box. The next step is really to invest in a portfolio into different asset classes, into various instruments, so that combined together asset allocation. No time to talk about this, but we roughly know that when you diversify and you put in different asset classes, different country, different geographic region, combined together, it will give you about 5% return, but be prepared for plus minus 3. And the thing is this. The thing is, no matter how bad the market goes up and down, you can stay invested because you need the 5%, you can take the 5%, and you're willing to. Now, I just want to say this. The couple that I spoke about just now, they really invested in a high, aggressive portfolio because they need it, right? Remember the MIT couple I talked about? Last year, they came to me and they scolded me. And they said, Chris, I told you I don't want to take risks. Don't complain because you put me in a very aggressive portfolio. This is a time whereby he has to sit down and rethink it again. This is a time whereby I have to hold his hand and say, look, now, let's go back. You needed your bungalow. You needed your car. Therefore, we worked it out that you need 9%, right? If you don't get 9%, you're not going to be happy, right? Do you need the 9%? Not one, no. Do you need? He says, yes, I need it. Now, look. Are you still physically healthy? Yes. Are you still covered with insurance? Yes. Do you still have the 6 months in your bank account? Yes. Do you have children? No. Income? Higher. Do you need money tomorrow? No. You have the need, and you can take it, right? Now, let's look at the stock market. It's been going up for the last 100 years. You've got the next 20 years to wait, right? 15 to 20 years to wait, right? Is it okay you stay invested? Yes, fine. It is when you invest in the correct risk profile because you have the need, you're motivated to stay invested, and you can actually stay invested because you have time, you have money, you don't need money, therefore you can stay invested. And if you do that, you truly get the investment return that you need. People, investing in the stock market is not buying a piece of paper. Most of us think of it that way. Investing in the stock market is about investing into real companies. The stock market fluctuation has nothing to do with the company on that day. The market can go up 10%, down 10%. It doesn't change the P&L that day. The up and down the market tells you what? It tells you about the greed and the fear of people. It doesn't tell you about true value of the business. You are investing in real businesses. Do you expect all the Microsoft, Intel to close shop? If you expect, then you shouldn't invest in anything. But however, if you really understand what investment is all about, all you really need to do is to stay there. Sit tight. Don't move. Go through the ups and downs. And that's where you get a return. You will not get fantastic and spectacular return. No, you won't get. But you will get the return that you need. And that's all we really want, and that's all we really need, isn't it? To have that money for retirement when we need to. And the next step after doing that, okay, is go back and check whether you have already bought those instruments. If you have, don't need to buy. And if you don't have, then you go and buy the instruments. And when you want to buy all these instruments, you want to buy the best of the best, the one that is suitable for you. Then you execute it either via the unit trust, ETFs, or other instrument. You either invest using cash, CPF, supplementary retirement scheme. You either invest lump sum or regular savings plan. RSP is regular savings plan, meaning to say you put in every month or every quarter. Okay? And then, is that the end? Put the investment certificate on the drawer. 10 years later, take out, suddenly all become money. Is it like that? As simple as that? No. You must do what? Monitor. What do you monitor? Or what must your advisor monitor for you? Can someone catch him and tie him outside? Because I don't like to see the 5 minutes. Okay, I'm left with 5 minutes. I'm just kidding. Thank you very much. Now, what must your advisor monitor? Or what, if you want to monitor yourself, you must monitor. Firstly, your investment can go up and down, up and down, up and down, up and down, but it must generally go up to get the 5, 7, 9% that you need. Okay, it can go up and down, up and down, up and down, but if you are investing on a 5% portfolio, it must not be more than plus minus 3 most of the time. Otherwise, too risky already, you cannot take it, you will jump out. The third thing you must monitor is whatever you buy over there, those instruments, those unit trust, ETF, it must remain suitable for you. And finally, after a while, your pie chart will change because market move. You must rebalance it back to the original proportion. If you don't rebalance it back to the original proportion, especially when market is doing well, we get greedy. Wow, stock market doing well, making a lot of money, and then, wow, why should I go and sell my performing equities and then buy the lousy bonds, you will say. But that's the point. The point is when you are selling your best performing equities and buy the bonds, you are taking profit. Can we see? You are selling the very expensive one and buying those very cheap ones. You are keeping the pie chart so that you remain seated on the correct roller coaster. So that when it goes up and down, it is something that you find suitable, you will not jump out. Because the minute you try and jump out, well, you may not get the returns that you need. I often like to use this as an example because I find it useful. If you cannot remember whatever I said over the last 30 minutes, just remember this, that investing is as easy as cooking. If you can cook, you can invest. Now, let's say, for example, today, we want to eat laksa, and there are 3 kinds of laksa out there. You have the Penang laksa, Katong laksa, and lemak laksa. Let's say you need to eat Penang laksa. You are very, very able to take the sourishness of Penang laksa, and you're very willing to eat it. So the laksa that you want to eat is which laksa? Which laksa? Penang laksa. Next step, go and find a recipe to cook your Penang laksa. After you find a recipe to cook your Penang laksa, go and find in your cupboard whether you already got the ingredient. If you have, don't need to buy. If you don't have, then you go out there to the supermarket and you find the most suitable ingredient for your Penang laksa. Once you do that, bring back home and you cook. Now, even if you follow the recipe to the very, very last dot, do you get exactly the taste of the Penang laksa you want? Never. All those people know how to cook? No, never. What must you do? Taste, add, subtract. That's monitoring. If we cook this way, don't invest in any other way. How many of us, when you go to the supermarket, you have no idea what you want to cook? So you go to the first shelf and see, wow, this is the best branded salt. Oh, okay, let me write down what I can cook this salt. Let me write down. Go to the next shelf and say, oh, this is the best branded soy sauce, Kikoman. Let me write down what I can cook with this Kikoman. Then you write down. Then go to the next shelf and say, this is the best ginger. Let me write down what I can cook with this ginger. Write down. If you go shopping like that, you will never go home. Because every ingredient can be the best. But it doesn't mean you need it, because you must first decide what you want to eat, right? So if you cook this way, don't invest other way. Always start with first you want to eat. A word about supermarket. Oftentimes when you go to a supermarket, you meet with promoters, yeah? You know promoters? Sample, sample, sample. Buy 3, get 1 free. And then if you buy 10, I give you 1 Tupperware set, free gift. If you meet someone who just pushes you a product, this guy is likened to a promoter. Is the promoter interested in what you want to cook? He only interested for you to buy. That's all. You must always start not with buy. Want to buy product? Very easy one, no? During the weekday, just go to any MRT station, stand there and say, I need to buy insurance. Or come. It's very easy to buy a product, right? But it's hard to start from what you want to eat. So always start with what you want to eat. I know I'm left with like no time and last minute, but I just want to quickly talk about this. Okay? And that is your ETF, because I always get this question. So I'm going to just talk about ETF and unit trust when this thing moves. And then I'm gone. Don't chase me out yet. Okay? Now, I have talked about the instruments and I said ETFs and unit trust. Now, one of the best way to invest is via either unit trust or ETF. I don't really recommend us to just buy 1, 2 stocks, because if the company doesn't do well, we are gone. And also, you can read all the financial numbers. You can never read what the CEO is thinking, right? People can blatantly cheat, yeah? I'm not saying all CEOs cheat. I'm just saying that it's impossible. Therefore, it's too risky. You might want to diversify your risk and go into unit trust or ETF. Now, a unit trust is this. I've explained this before. It's good to know that, well, for example, you want to buy into US stocks, let's say, but you don't want to buy 1 US stocks and you want to buy many, but we don't have money to buy that many. So what do? Well, we pool our money together. Every one of us put $1, some of us put $2, some put 1, some put 3, whatever amount you put, and then you buy into a fund. Say this fund is managed by one of the fund manager. For example, Mr. Aberdeen. You heard Aberdeen, right? You take MRT, you always see Aberdeen, right? Aberdeen. Mr. Aberdeen is one of the fund managers. Mr. Templeton, Mr. Schroeder, these are the fund managers. So you get Mr. Aberdeen to manage the money. He cannot work for free. You got to pay him. There is an annual management fee, like say, for example, 1.5% per year. Now, to make sure that Mr. Aberdeen only buys US stock, you got to legally bind him. So you buy him with a trust. A trust is an instrument that tells Mr. Aberdeen that he can only buy US stock. And depending on how much you put in, you get like shares, but we call it units. And because you get units, and this is bound by a trust, this is a unit trust. A unit trust is not an asset class. It is a collective investment scheme. It's a scheme, it's a structure. Understand? ETF. ETF is almost like this. However, the difference is, it may not be a Mr. Aberdeen that manages it. This manager that manages this fund, he doesn't choose which US stocks to buy. He will buy every stock in the, for example, US stock market. So he diversified the risk completely, understand? And this particular fund, the interesting thing is, it is listed on the stock market like a company. By buying that fund, you own the entire US stock market and you can trade. You can basically buy, sell and buy that particular fund. It is listed on the stock market. The unit trust is not listed on the stock market. Am I being clear here? If you want just market returns, the ETF is a good instrument. If you want better than market return, then go for the unit trust. But I'm going to ask all of us a question before I go. Do you need to beat the market all the time? If you don't need to beat the market all the time, select the suitable instrument for yourself. At the end of the day, investment is really simple. Don't get distracted by all the things that change. Many things can change. Crises will come, crises will go. And the only way to help you invest properly is to remember that principle. And that is the stock market always goes up. And as long as you're investing based on your need, you are investing based on the ability to bear the up and down, you are fine. And all you need to do is just to sit tight, don't move. And as long as you have time, you will get the return that you need. All right, with that, I thank you very much.
Thank you, Christopher.